Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Nathan Lowe of Raanana Ziontech Partners. Thank you for joining us.
Thank you so much.
Can you tell us about your background and what you did before you started your current project?
Sure. Thank you so much for having me. I grew up in LA. I went to school in Boston. I worked in semiconductors in all aspects of semiconductor production and logistics and manufacturing control, production control, sales, marketing in LA, in Mexico, in the East Coast, in Europe, and in Israel. And I was very taken now 34 years ago, with the high-tech scene in Israel. And after I built up my investment bank in New York, I then started angel investing first in New York City and then in Silicon Valley, where I invested in 40 companies as an angel. And then later, over the last 25 years, in 81 companies here in Israel.
Well, I always ask experienced angel investors, what's your advice for people that are just now starting to angel invest? What one piece of advice would you give them at this stage?
The single most important piece of advice, apart from doing serious due diligence and investing with other angels who know what they're doing, is that you must diversify into 10 or more investments because you don't know which ones will succeed. You know that most of them will fail. But the one that succeeds, if you are lucky enough and fortunate enough and pick well enough, could and should exceed the other 9 losses if you do 1 out of 10. But if you've only done 5 or if you've only done 3, you have a very high chance that you're not going to hit that 1 out of the park winner that pays for the others. So you could lose 3 out of 3, you could lose 5 out of 5, you could lose 9 out of 9. Once you get to between 10 and 20 investments, then you have a much better chance, having picked well in all of them, that at least one of them will succeed. And so you have to, A, risk capital that you can afford to lose, and B, divide it in at least 10 buckets so that you are properly diversified with a better chance of having the outsized winner or more than one.
I certainly appreciate that. It's just really hard to tell who the winners are up front, and it's almost never the ones you expect. So that's good advice. But let's talk about your investing in Israel experience. And maybe you can start off with what's your current track record there in doing that?
So I've invested in 81 companies here in Israel over the last 25 years. The first 20 years I did it from New York by visiting Israel or having the Israeli companies visit me in New York. And for the last 5.5 years, I've been doing it full-time, pretty much full-time, here in Israel, and looking at approximately 300 companies per year, maybe diligencing 50, and investing in approximately 5 companies per year. I think we've done about 21 companies over the last 5.5 years here, and got some nice deal flow from IBM and Citibank and Microsoft and Deutsche Telekom and Telefonica and Ernst & Young and Allianz, who refer companies into me, and companies they like but have problems. And so I go to these companies and tell them, hey, so-and-so likes you, but you have the following 6 problems that we need to fix. And so the idea is that if you agree to fix all these 6 problems, and if you fix all these 6 problems, our investors, which include anyone who is a friend of yours or a friend of mine, gets to invest on the same basis that we invest and doesn't pay a fee. And if you don't fix all 6 problems, you get all my work for free, and I never show it to my friends. So these people have an incentive to fix the problems. I help them get the right board members, fix their cap structure, fix their IP, whatever happens to need to be fixed, get them the money, the $1 or $2 million typically that these companies need to accelerate from a finished product into not honest, but legitimate sales and marketing on a worldwide basis with a channel partner. And so the whole idea is to accelerate people into profitability with an infusion of capital.
So why did you choose Israel out of all of the world? Most people choose the U.S., but you chose Israel. What was the reasoning for that?
So over the last 25 years, there's been a seesaw between Israeli valuations and Silicon Valley valuations. For the first 15 years of my 25 years of investing in Israel, Israeli companies were 3 times more expensive than Silicon Valley companies. There were too few companies here and too many venture capital firms here in Israel. And so you had too much money chasing too few dollars. And the price mechanism means that the price of companies goes up even if the prospects haven't improved. In Silicon Valley, over the first 10 or 15 years, you had a tremendous number of companies and not as much money relative to how much money you have today. And as a result, with all the successes of Google and Facebook and Tesla and Twitter, and you go through the whole list of seed investments versus IPO prices and beyond, so you now have tens and tens and tens of billions of dollars more coming from the various 10 teacher pension funds and retirement pension funds of the Ohio teachers and Pennsylvania teachers and wherever. And as a result, you don't necessarily have a market increase in the number of companies in Silicon Valley, but you have a many-fold multiple increase in dollars. So the price function means that not only do you have 100 or 200 unicorns in Silicon Valley, but you also have, according to a Price Waterhouse study, an $8.3 million pre-money seed, 2 guys, a dog, and a napkin company in Silicon Valley, whereas in Israel, you have an average, according to that same PwC study, a $2 million average for 2 guys, a dog, and a napkin. It could also be 2 girls, a dog, and a napkin, but it's first day company with just a slide deck. In Israel, typically when you get to an A round, it's around $6 million pre-money and $8 million post-money. So you can invest in a company that has a finished product, that has a POC, that has maybe $10,000 of revenue at an $8 million post-money 2 years later down the road with no risk of execution in terms of the product, where you just have market distribution and channel risk, which we actually try to address before we invest. But if I could invest in a finished company, quote unquote finished with a quotations around it and a lowercase f, at 8 million post money versus Silicon Valley 8 million point three pre-money, maybe you have to put $3 or $4 or $5 million into the seed round. You still have 2 years to go, and you have a 90% failure rate between the seed round and the A round. I just think it makes more sense, and you're 2 years closer to your exits, and you have a much better IRR because you have 2 years fewer in the calculations.
So certainly you get better valuations and you get probably just as good a tech team in Israel. But tell us more about the Israel tech ecosystem and what that looks like today.
So unlike when you were here 20 years ago with National Semi or National Instruments, you had maybe 100 companies in the ecosystem. You now have 7,000 tech companies in the high-tech ecosystem here, small ones, startups. You have 5,000 medical companies in addition to the 7,000 non-medical companies, and you have 1,050 new companies every year and about 1,000 companies every year closing their doors and folding up tent. You also have 340 international research centers here, Intel and IBM and Huawei and all the European firms and General Motors. The CTO of General Motors comes to Israel for 1 week every month. He spends 2 weeks in Detroit, 1 week in Israel, and 1 week somewhere else in the world. It's crazy that GM now has 2 buildings here, and they believe that the future of General Motors comes right through Herzliya, Israel. It can be the same said for Motorola that's designed all their chips here, National Semi, Intel, Hewlett-Packard, and the list goes on of chips being designed here. Facebook and Microsoft have enormous complexes here, and they buy 5 or 6 Israeli companies every year, as does Apple. Amazon put up a new center here, and they're trying to hire 5,000 engineers here in a year, which is an impossibility. And so companies buy, large world companies buy companies here in Israel, and the first thing they do is add 200 requisitions to the 50 engineers they just bought, and they just want to do more R&D here. You now have the Chinese companies, the Japanese companies, the Indian companies that are here every week trying to invest in companies and buy companies. And so part of our thinking was get good referrals from Deutsche Telekom and Telefonica and Ernst & Young and whomever, diligence the companies, invest in them, and basically manufacture these companies for sale, not for IPO, But when we sell a company at 20 or 30 or 50 million, if that's what the bid is, and we manufactured it at an 8 million post money, we could have a nice return. Those are all theoreticals. If, on the other hand, you're investing in that same company in Silicon Valley at a multi-$100 million valuation or $1 billion unicorn valuation for the same technology, all other things being equal, when the large Western acquirer or Eastern acquirer comes and pays only $30 million, which is the average strategic exit across all companies worldwide, if you're in at a multiple of 30 million, you lose money. And if you're in at an 8 million post money and the 30 million is the bid, then you are making 3 or 4 times your money, all other things being equal. So when the bidder comes and they're only willing to pay $30 million for a company that is hitting some sort of a revenue ceiling, but could have an unlimited revenue with a worldwide distribution partner, and so they're willing to pay whatever they're willing to pay, the worldwide distribution acquirer for a strategic exit doesn't care what the last valuation was at. They only know that they're going to pay 30 million in this hypothetical example. So I'd rather be manufacturing companies sub $10 million valuation with the possibility of an exit rather than manufacturing them in Silicon Valley where the prices have been bid up because there's an excess of capital and a relatively constant number of companies.
So you spent a lot of time in Silicon Valley where there's the heartbeat of venture capital. Let's talk about that for a minute. What is the success rate of VC-funded deals in Silicon Valley?
I believe that the Silicon Valley rates, the Israeli rates, and the worldwide rates are anywhere from 5 to 10% for seed startups. And some of the VCs in Silicon Valley have a slightly higher rate, but they back lots of companies with $500,000 or $250,000, and it never makes it to an A round. So when you look at all the numbers, all things considered, the various centers of excellence around the world have roughly comparable rates of exit. Again, your IRRs can vary depending on how high is the pre-money and post-money of the rounds that you get into versus the sales or exit price. And just because we can name 20 unicorn IPO exits, but you had 10 or 12,000 failures, you're looking at 1.5% of extraordinary IPOs, another 3, 4, 5, 7% of exits, and 90 or 93% of companies that did not exit. So one can't extrapolate from the exceptions that make the newspaper. One has to look at these PwC and other studies where they catalog 10, 20, 30, 40,000 startups and actually count the results of each and every one of them.
Well, there have been many VCs that have been around for a long time, but it seems like the VC industry is changing. It's going out broader and further to more groups. We have micro VCs. We have VCs doing accelerator programs now. But how are the traditional VCs doing? How are they holding up the brand names and the marquee names from many years ago?
So some of them have done extraordinarily well, and they often recycle with a newer set of partners, and the older guys take a lesser role. And some of the brand names like Sequoia and others have done truly extraordinary things. You have newer VCs like Spark and others that have done extraordinarily well. It's all a question of trends, but one also looks at what's going on with SoftBank with their $100 billion vision fund, and rounds are getting really, really large and really, really pricey. And you also have a tremendous number of dollars going into these unicorns. And, just think about every time Uber raises another $4 billion. And so those can skew the numbers also. So I don't understand these mega rounds and the spending of money to sort of buy eyeballs, sort of the 2019 version of 1999, buying all eyeballs. We don't know how to monetize it yet, but eventually we'll figure it out. Well, when the stock market went down 97% for the best of the NASDAQ companies, Yahoo went from 300 to 9, then you can see that eyeballs was not a strategy. And so I'm not sure that unicorn investing and these giant C and D and E and F and G and H rounds are in all those preferences which stand before all the people that came before. I'd much rather be in a company manufactured for sale at a $6 or $8 or $10 million post money. And if we get to a $300 million or a $500 million or $1 billion strategic exit, wonderful. But what we're really hoping to do is hit singles and doubles and triples and leave the home runs to the professionals in California.
So, how do you achieve exits for all those companies in your fund? It doesn't seem like it's that easy for angels to do that, but how do you do that on a consistent basis, one after the other?
So our goal is to, during the due diligence period, identify who are the likely channel partners among bigger companies, whether in Asia, in America, or in Europe. And at the same time, identify who might be likely buyers in an auction. And the real way to get a good exit is to have an auction. If you have only one bidder, the price that he wants to pay, he or she, is whatever it is. If you have two people bidding, then you have deal tension and the price can go up, sometimes remarkably so. And so if one can identify 3 or 5 or 7 or 9 likely bidders for a company 2 years out or 3 years out, where you can show the hockey stick and they will be willing to pay 5 or 10 or 20 times revenues, all of which is hypothetical. The part of our due diligence is finding channel partners who during the due diligence period at least verbally express an interest in doing distribution of the product, not necessarily requiring the company to sell themselves to them. And then you identify who are the likely people when you can show them 5 or 10 or $20 million of traction in terms of revenues that would want to pay a multiple because then they see enough market acceptance and there's a donut hole in their product catalog. And because of quarterly earnings pressures, they're not willing to spend on R&D. And as somebody said to me last week, American R&D is spelled M&A, by which they mean mergers and acquisitions. And so they'll pay $100 or $200 million, which they can depreciate as a cost of acquisition, where they were not willing to invest $1 million a quarter in terms of R&D for something that may or may not succeed. But they'd much rather spend. The same thing in the pharma industry. I don't do pharma much now. I used to do a lot of it 15 and 20 years ago. You could spend $10 million on each of 100 biotechs in their R&D and expense $1 billion against your earnings and your stock would get slaughtered. Or you could spend $1 billion buying something the moment after the FDA approves it. We would have 1/100th the potential of the 100 companies, but nobody ever got fired for spending $1 billion, depreciating it over 20 years, and not hitting their quarterly earnings. So the pharma industry would spell M&A, it would spell R&D with M&A. And I think the tech companies that are hyper focused on their quarterly earnings don't spend it on R&D in this sort of applied way, but rather do niche tuck-in acquisitions and then blow out the revenues through their 150 countries of distribution. So we see a tremendous trend. I mean, there are literally hundreds of companies in Israel that are purchased every year. You open up the newspaper or you open up any of the digital newspapers covering the high-tech industry in Israel, and literally 5 days a week, you're seeing one more company from Japan, from China, from Europe, from America, buying an Israeli company almost every single day of the business week of the business year.
Well, that sounds great. It sounds like there's a tremendous M&A activity going on there. As you do your work in Israel, what do you find are the challenges in doing that these days?
So the challenges are to find enough management talent that has either made money before or lost money before, but had experience in taking a company overseas. Our domestic market here is only 8 or 9 million people, which is the size of a larger city in the United States like New York, or it's the size of a small city in China. China has, 40 cities with more than 10 million people, and we only have 9 million people in the whole country here. So our market is an export market. And since you're dealing with software mainly, it's very easy to export. It takes way too long to set up 100 countries of distribution. And if you could do it over 10 years, you'd be 8 years too late in getting to market. So the real secret is coming up with a channel of distribution that can jumpstart your international distribution. And that's one of the things we do during the due diligence period, is try to identify the channels of distribution that can turbocharge the sales of an already finished product. But you need to find management that knows how to partner, knows how to do channel sales, knows how to incentivize channel sales. And in general, you want someone that's done it before.
Well, great. Well, in the last few minutes that we have here in this session, what else should we cover that we haven't?
The trends in Israel are not any different than the trends in Silicon Valley. You have AI, you have big data, you have natural language processing, you have connected car, you clearly have cyber. Israel has 20% of the world's cyber revenues. I think if I had to summarize it, I would say that Israel had a technology advantage in the 70s and 80s in terms of DSP, digital signals processing. Those people then went into the commercial industry. And as a result of going into the commercial industry, everything that is DSP, that is an algorithm, that is detection of anomalies, is relevant to Israeli industry and relevant to the world. So Waze, a computer app that most people have used for driving from here to there all over the world, is digital signals processing of everybody's car and everybody's phone in everyone's car, giving back a signals of how fast are they going on each block or on each section of highway. There are cervical cancer detection companies that do anomaly detection of how do these cells look versus other cells of pathologies of women that have had cancer or not had cancer and avoiding biopsies. You have digital signals processing and anomaly detection in cyber, digital signals processing and anomaly detection in pricing for logistics of freight worldwide, and the list goes on. There isn't a single human endeavor that cannot use anomaly detection by computer with the cost of computing asymptotically dropping to zero, the cost of storage asymptotically dropping to zero, the cost of communications asymptotically dropping to zero, where you can use the anomaly detection DSP to go ahead and analyze a set of data, come up with the anomalies, and whether it's a cyber detection or a cancer detection or a traffic pattern detection, should I go down First Street or should I go down Main Street to get to my destination faster? That's where Israel has a true strength, and it just accelerates as more and more graduates leave the military, which is compulsory service for all young people. And as a result, this DSP, anomaly detection, big data, AI, NLP, it's all the same field in different flavors. That's why Israel is so strong right now as the world is adapting all of these technologies to large, big, established businesses that could use a little more efficiency improvement.
Well, that's fantastic. So, how best for the listeners to get back in touch with you?
You have my email, you have my website, you have my LinkedIn profile. Whatever anybody wants to do, I'm always happy to speak to accredited investors. That's the most important thing. One needs to be accredited to look at this sort of stuff.
Well, great. Well, we'll put those in the show notes. Thank you for taking time to share that with us today, and hope to have you back for a follow-up. And with that, we'll close it out.
Thank you so very much. Take care and have a good evening. Thank you. Bye-bye.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.